Welcome to Industry Focus, the podcast that dives into a different sector of the stock market each day. It's Monday, November 5th. I'm your host, Jason Moser, and joining me in the studio, as always, is certified financial planner Matt Frankel. Matt, you have a good weekend?
I did. I went to a wedding in North Carolina, and there were no cell service, no internet, no nothing. It was in the middle of the mountains, and it was really weird to unplug.
So you were disconnected, as they say.
Like as much as I ever have been.
That's a foreign feeling. I can't even remember the last time I was in such a position. Man, I tell you, these days I don't even understand how you go for like an hour without checking your phone. It's a bad habit. I got to get out of it, man.
Yeah, you should try doing it for a weekend sometime.
Well, on today's show, we're going to talk more earnings, of course. We're going to talk about some changes, some IRA changes that you need to be aware of, some interesting wages and salaries data. We'll tap into Twitter. We'll have one to watch for you, and we're going to start the week with Uncle Warren, his latest investment in the payment space. Berkshire Hathaway earnings came out over the weekend as well, so a lot to talk about really with Berkshire Hathaway. And let's just go ahead and get started first and foremost with this Berkshire buying into Fintech, because, Matt, this was something that I don't think a lot of us were really expecting, but it's also not terribly surprising. I mean, he likes investing in those market opportunities, and I think more than anything, the most interesting part was just the companies he decided to invest in, right?
Right. Well, just to be clear, first of all, this wasn't initiated by Warren Buffett himself. He doesn't understand these companies well enough by any stretch to make an investment in them. This was by Todd Combs, who's one of his two main stock pickers, and he's definitely the more techie of the two. But Buffett gives him his stamp of approval, so we can consider it a Warren Buffett investment.
Sure.
The two companies, they're both foreign companies. There's Paytm, which is an Indian mobile payments company, and StoneCo, which is in Brazil. And at first glance, these might sound kind of weird. Like, why would Berkshire be looking at some foreign fintech companies? But they do both have a bunch of Berkshire-like qualities. First and foremost, they are market leaders in their economies. They both have big market shares. They're both very well known in their local markets. So they do have that going for them. It's like how Berkshire invests in Coca-Cola because it's the leading, soft drink provider. Same idea there, just on a more fintechy and rapidly growing scale.
Right.
And only one of them, StoneCo, is the only public one out of the two, I believe. And these are both relatively small investments for Berkshire, $300 million a pop, which sounds pretty big, but not when you're talking about a $500 billion company. So, yeah, I'm glad to see Berkshire finally putting more of its cash to work in kind of outside the box ways. They've had a real issue kind of building up cash. They still have more than $100 billion after spending some of their money on a bunch of new stock investments and things like that. So I'm really excited that they're finding ways to put their money to work in ways that could actually end up moving the needle if these companies prove really successful.
Yeah, I mean, it's no secret. We obviously love these payment companies all over the world. I mean, plenty of opportunity out there. And he noted payments are a huge deal worldwide, is what he said. And this, they already own, Berkshire already owns stakes in Visa, MasterCard, and American Express. So it's neat to see them get some of these smaller firms in there that are a bit more based on technology, like you said. Yeah, definitely a little bit more difficult to understand. But, I think this is also really a testament to the kind of team that he's building there at Berkshire Hathaway. And I think investors need to feel really good about that. Now, when we talk about Berkshire Hathaway, I wanted to mention a little bit about just the earnings that came out over the weekend for them, because it was, generally speaking, a pretty good quarter. They saw a nice bump in operating income there. It did seem like the insurance underwriting profit saw a nice boost versus last year, and I think there were some natural disasters last year that hit them on that line, of course. But another quarter of big share repurchases for Berkshire Hathaway as well, wasn't it?
Well, this is the first time they've been allowed to repurchase shares under the new plan that allows Warren Buffett and Charlie Munger to pretty much buy back shares whenever they both agree it's a good time. Berkshire bought back $928 billion worth of shares this quarter, which sounds like a lot, but the takeaway here is not that this is a real needle-moving thing. And like I said, Berkshire's a $500 billion company. Buying back less than $1 billion worth of stock isn't really anything to get that excited over. But the takeaway is that the new buyback policy says that they can only buy it when Buffett and Munger both agree that the stock is trading at a substantial discount to its intrinsic value. So the takeaway here is that Buffett really considers Berkshire cheap at the current levels.
Yep. And I think right now it's at around 1.4, 1.5 times book, right?
Yeah, which is actually pretty low for Berkshire. Berkshire kind of, if you look at the history, kind of oscillates between 1 and 2 times book. So it's not that expensive in a historic context. Yeah,
and that the former hurdle that benchmark that they had given themselves was 1.2 times book, which seemed very reasonable. But by the same token, I don't have any problem with them lifting that benchmark and just saying essentially, hey, we'll just do it when we feel like it makes sense, because that's ultimately what they're doing. They've got a pretty good track record so far, so I think we can trust them. I do wonder how some shareholders may feel about that versus dividends. I mean, certainly dividends are something that they're going to hear more and more about as time goes on, I think. So I wonder if that's something they're going to feel a little bit more pressure to cave into at some point, but haven't really gotten any sense of anything like that in regard to dividends yet. Have you noticed anything? Do you have any feelings there?
Well, as the cash was starting to build up, Warren Buffett was for the first time ever, I think, mentioned dividends as a real possibility. And then he kind of walked it back over the next few quarters. And his attitude is pretty much say, if you want a 3% dividend from the stock, just sell 3% of your shares every year. He said, trust me to do what I will with the profits. And if you want income off Berkshire, just start gradually selling your stock that way.
It's a fair point.
It's tough to argue with it. I mean, I'm a financial planner, and I would trust my money with Warren Buffett. So I trust him to make the best decisions with Berkshire's income.
Well, if he's good enough for you, he's good enough for me. He should be good enough for all of our listeners. That's the takeaway. Okay, let's talk about these IRA changes, because I thought this was pretty neat. I was also a little bit taken back by the fact that this is the first increase to the annual contribution limit since 2013. But you published a nice article here. We'll get that out to our listeners. Talk to us a little bit about this IRA increasing the limit on contributions for 2019.
Yeah, so the IRS increases contributions, or looks at them every year for things like IRAs, 401ks, and other types of retirement vehicles. For IRAs, it's a pretty big jump. This is almost a 10% jump from $5,500 a year as the standard maximum contribution to $6,000. The reason being, they adjust this upward with inflation over time, but can only do it in $500 increments. So for, say, a 401k where the maximum was $18,500, a $500 jump isn't that hard to come by when you're talking about inflation. But with an IRA, that's like almost a 10% jump, and it takes a little bit of time before we get 10% inflation. Hopefully, if we're getting 10% inflation a year, we have other problems in the IRA limit. But this is a big deal for retirement savers, because it means that anyone who uses an IRA as their primary retirement savings vehicle has the potential to set aside an additional almost 10% a year for their retirement. Most people with IRAs, unlike 401ks, max out their contributions every year. I think the average is right around $5,000 as an annual contribution, and the maximum was $5,500. So it's fair to say that the majority of people with IRAs come close to at least maxing out their contribution. So this is good news in the kind of pending retirement crisis that you keep hearing about, that the average American will be able to set aside a little more for their retirement if they choose to do so. Well,
that's always good news. And of course, we encourage anyone and everyone out there to start saving for retirement, no matter your age. You can't start soon enough. And we'll make sure to get that article tweeted out there on the Industry Focus Twitter feed for you, Matt. Now, we also saw some news here that wages and salaries this recent quarter here jumped by 3.1%. And the reason why this seemed noteworthy to me, it's the highest level in a decade. And we talked a lot about over really the past several years, as unemployment has started recovering, that wages always seem to be a little bit of a point of weakness there. While jobs were coming back around, wages weren't necessarily moving as much as someone would want to see. It appears, though, now that we have seen at least some kind of a jump there. What's your take on that? Is that something that's sustainable? Is that something that's going to play out in a good way on the economy, or what?
Well, it's definitely sustainable, but from an economic standpoint, you want to pay attention to what's called real wage growth. That is, are wages growing at least as fast as inflation?
Yep.
Just to kind of put it in context, if your salary goes up by 2%, but it costs you 2% more to pay for your mortgage or pay for your rent, pay for your groceries, etc., you really aren't making any more money. But on the other hand, if wages are going up 3.1% like we just learned, and inflation is rising at about 2%, then your purchasing power is rising over time. And that's what we really want to see. That means everybody's collective standard of living is going up over time. So, yes, wage growth is excellent, highest number in 10 years, but pay attention to inflation, especially as we kind of go on this rate tightening cycle and the Fed's kind of monitoring the economy like they are right now to see what the next move is.
Yeah, that inflation lesson is a really good one. We talked about it with some of our Fool School classes. We'll meet with Girl Scout troops or classes, kids around 10, 11, 12 years old, and give them some ideas as to how inflation works. And we talk about it from the perspective of having your money in a piggy bank versus having it in a bank account versus having it in an investment account. And you can see over time, obviously, your money's going to be very safe sitting there in the piggy bank, but over long periods of time, that inflation takes hold and actually erodes that value of that money in the piggy bank. So, the piggy bank is safe, but it actually is, it's kind of hurting you there because you're not keeping up with inflation. So that was the lesson that really got a lot of their attention there. And once you can start understanding how that works and how it really works over long periods of time, I think it really helps justify the case for not only investing, but really investing the way we do here and taking that longer time approach there. Okay, Matt, let's dive into earnings palooza. It just keeps on coming, man. I tell you, we've got more companies reporting this week. We had a lot of companies that reported last week. And let's go ahead and kick it off here talking about MasterCard. Tell me what you saw for their most recent quarter.
Well, it was good. The stock popped right after the earnings, so everybody liked what they saw. Earnings were up by 33% year over year. Revenue grew by 15%. So anyone who thinks companies like Visa and MasterCard are maxed out, this proved them wrong once again.
I'm maxed out. I like that. You probably didn't even mean
no
to
pun
do
intended. But the things that really were encouraging to me were, one, cross-border transactions, meaning the international revenues, were up by 17%, which was the strongest of their main areas of growth. So that was very encouraging. And not only that, but their margins are getting better. Their expenses only went up 11%, while their revenues went up by 15%. And as we've said many times, anytime your revenue is growing faster than your expenses is a very good thing. MasterCard's margins were higher by over 2 percentage points. And the other really big thing that stood out to me was the kind of aggressive buyback that they're using. I know everyone's buying back stock right now, and it's kind of the buzzword of the day given the tax reform savings. But MasterCard not only bought back $1.2 billion worth of stock in the third quarter alone, they came out with their earnings report and said, we took advantage of this big market correction in October. In the first 25 days of October, they bought over almost $360 million more on top of that $1.2 billion.
Wow.
So it's really nice to see them being proactive and saying, we took advantage because we thought our stock was dirt cheap in the beginning of October, so we bought a lot more.
Well, as a MasterCard shareholder, I like everything you just said there. So let's keep it going in that direction there. Take a look here real quick at Fiserv. And Fiserv, this is an interesting business. I think it flies under the radar for a lot of people, but it's a really good business because it is the company that provides the software for a lot of these smaller financial institutions, smaller banks and whatnot. They provide the software for these banks to get their work done, the ledgers, the payments and whatnot. So again, it's a good business. The stock is having a decent year so far. It's pulled back a little bit here, but it obviously is benefiting from the growth in electronic payments. Generally speaking, from a business perspective, they benefit from switching costs. Banks don't typically like to switch operating systems very often. That's a pretty big undertaking. And so really what this means is Fiserv is a partner that grows with these banks and continues to offer more services. And what this ultimately does is gives Fiserv a little bit of pricing power as time goes on. And we'll see them exercise that here and there. But generally speaking, you're looking at a business that's going to continue to grow around 4 or 5% organic growth. But they really do a good job of bringing it down to the bottom line. And when you talk about those share repurchases, if we look at their share count going back to 2013 to today, they have brought that share count down 22% in that period of time. So they continue to do a really good job in buying back shares and helping realize value for shareholders. It's not something that's going to sit there and double overnight, but I think it's going to be a nice slow grower for folks looking for some financial exposure there. And let's talk about Paycom as well. Matt, you went through their quarter. What'd you find?
More good things. Revenue and earnings were both up by 32 and 33% respectively. The reason I love Paycom, and they just announced that recurring revenue, it now makes up 98% of their total. If you're not familiar, Paycom's the online, the payroll processing software company. 98% recurring revenue is a pretty nice moat. This is a service that companies need. Businesses need to process payroll. So this is a great recurring revenue stream. It's growing at, like I said, a 33% year-over-year clip right now. And they're not buying back shares very aggressively. They said they bought back about 30,000 shares, which is, a drop in the bucket. But they're plowing all their money back into growth, which is exactly what they should be doing. If you can have 98% of your revenue be recurring and grow that at the same rate for another few years, they're going to be in really good shape.
Yeah, recurring revenue is a beautiful thing. We'll wrap it up real quick with Markel, another one of our foolish favorites here. We've talked about this business for many, many years, and it's our baby Berkshire, as we like to call it. But another very good quarter for the company, and we talk about the three main drivers of the business in the insurance underwriting, and they stood at $4.5 billion in insurance underwriting this quarter, $4.5 billion up for the first 9 months of the year versus $4.1 billion a year ago. And we also talk about their investment income, which was up to $320 million from $304 million a year ago. And then the Markel Venture side of the business, that's their investments in these smaller businesses, and they take meaningful stakes in these businesses. And I think they have somewhere in the neighborhood of 17 or 18 in the portfolio now. But that profitability, they brought in $1.4 billion in revenue on the Markel Venture side versus $933 million a year ago for the first 9 months of the year. So seeing some very good performance there in the Markel Venture side of the business as well. They just keep on doing a lot of the same things here, just running a smart business. And co-CEO there, Tom Gaynor, he's a leader we like. We've had a chance to speak with him a number of times. And so as a Markel shareholder myself, I'm happy to see that they're doing what they're doing. And I think shareholders should remain very encouraged about where this business is headed. Let's tap into Twitter this week. We had some questions that we wanted to get to here. And so first one here is coming from @MarerPowerin. Matt asks, why, in the light of the Equifax breach, would it be a good idea for everyone to have their banking information shared? It sounds like the super FICO, and I think he means the ultra FICO that we're talking about, only benefits a small number of people, yet everyone will have their data shared potentially without consent or consequence. Matt, you wanted to clarify a few things in regard to this question, right?
Yes, it's a good question, but when I spoke with the FICO people at the Money 2020 conference a couple weeks ago, they really clarified this, because that was one of my first questions that I asked them is, I don't want, everybody having my bank account information on top of my credit cards and things like that.
Yeah.
So there's two kind of points I wanted to clarify there. One, your banking information will not be added to your credit report. This is not going to be part of your 3-bureau credit report that people can access, that you can access, that Equifax, Experian, and TransUnion maintain. So your bank information will not become a component of your credit report. 2, you have to opt in to individual lenders for the Ultra FICO program. In other words, if I'm applying at a certain lender and my credit score is a little too low for the loan or whatever other product I want, I can say, okay, here's my bank account information, run my Ultra FICO score, or however the model works. But it's an opt-in with an individual lender, so it's not that everybody is going to have your bank information. So it's a little more legwork on the process of the consumer because your information isn't really just out there for anybody to access through your credit report. But it is kind of nice in the interest of data security, as you mentioned, to have the ability to give your bank account information or not give it to any lender you're applying to.
Yeah, that's key. I think the control is the key there, and it seems like the consumer at least will have that option, and that's important. And that leads to this next tweet I wanted to read off from @tsprings11. This is Troy. He was actually an intern with us here at The Fool. But Troy says, I love the Ultra FICO concept. I wasn't able to get a credit card until I became a USAA member. They just verify military, not credit score. Meanwhile, I had a job since 14. I'm a college graduate with no student debt and good financial shape. And I tell you, I wanted to read that off because I think that really is important here. I think that's where the Ultra FICO can have a great effect or a great impact on helping people who just don't have established credit yet. And if it's something where you can bring in actual real behavior based on savings and checking, I mean, that's a great alternative. It's a great option to have, I think. And certainly, I think Troy made a very good point there. And it sounds like someone like him would benefit from that. So thanks, Troy. And then finally, from @BT Capital 12 asks, can you guys comment on the lawsuit filed by Walmart against Synchrony? Do you think it's really just part of a bargaining strategy for the receivables, or is there more to this? Also, do you then think that COF, and I have to look that ticker up here real quick, but do you think
Capital One? Capital
One, there we go. Do you think Capital One is getting the short end of the stick as they won the Walmart deal? Folks, remember, you can always reach out to us via Twitter, and these are just some great questions here. But what do you think you have? What do you have there for BT Capital here, Matt?
Well, it's kind of like a he said, she said at this point. Walmart's claiming that Synchrony didn't use great underwriting standards when approving people for their co-branded card, and it resulted in higher than expected losses and therefore lower income for Walmart than they were promised with the deal. So they're suing for $800 million to recoup whatever they feel they lost. Synchrony's claim is that this is just a baseless lawsuit. They use their same underwriting standards that they use for all of their store credit card products, and that Walmart is just trying to get out of paying market value for that loan portfolio, which they agreed to do if they broke the deal. So the outcome of this remains to be seen. I tend to think that Synchrony will be the winner. I don't think Walmart's going to get $800 million out of them. They may end up settling at some point. But Synchrony, this goes beyond, I mean, their business goes beyond the Walmart partnership. I think at their growth rate, they'll make up the lost revenue, and they're not terribly worried about the Walmart revenue. They just want to kind of put it behind them at this point, and the lawsuit's preventing them from doing that.
Well, all right. Sounds good. I appreciate that, Matt. I'm sure our listeners do, too. All right. Let's wrap up the week here, as we always do, with one to watch. What is your one to watch this week, Matt?
My one to watch is Synchrony. Actually, not only is it down about 10% after the lawsuit was announced, but as I mentioned before, I just love their high-yield business model. It's a very efficient company. I had the chance to meet with their management team. I think they have great leadership. And there's a couple of really promising avenues they're taking their business. The Care Credit healthcare product has a lot of runway as more healthcare costs are being shifted to the consumer. They're starting to bundle a lot of their store card products together, like all of their different home goods retailers. They're going to offer one credit card product that can be used across all of them. Same with auto parts. So there's a lot of runway for growth here, I think. And as they're bringing in more and more retail deposits, their cost of capital is getting lower. And I just think it's a great time to get into this at a big discount. And hopefully I'll be able to shut up about Synchrony for a few days so I can buy some.
Yeah, that's a reminder. We do have trading guidelines we have to adhere to here. So if we talk about it, we can't buy it. And if we buy it, we have to shut up about it for a while. And what's the ticker there for Synchrony, Matt?
It is SYF.
Okay.
So if I don't mention Synchrony next week, that might be why.
Yeah, that's always a good thing to remember. I was trying to figure out, did I want to get Berkshire Hathaway as my one to watch or Markel, because I just really love what both their quarters look like. I'm going to go ahead with Markel just because I am really enthusiastic about where this company is headed. It's still a fairly small insurer, but they're building this business in that Berkshire Hathaway model, and it just is. It's exciting from a number of different perspectives. I love the Markel's Ventures side of the business, and again, I mean, I think that Tom Gaynor really just is doing a lot of great things with these guys. So Markel, ticker is MKL. I think that that one should be on probably everybody's radar here at this point. And hey, listen, folks, the other thing you need to have on your radar, why not go check out the Motley Fool's newly renovated YouTube channel, where you'll find clips from all of our podcasts in our entire Foolish family. Just go to youtube.com/The Motley Fool and check it out. Dylan and his team have done a phenomenal job of putting together some really great content there. You get stuff from all the podcasts and more. It's just an excellent experience there. Matt, thanks again for joining us this week. This is a great show as always. I appreciate it.
Always. I love being here.
All right, folks. And as always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. This week, the show is produced by Ann Henry. And Ann, happy belated birthday. That's just great. You're taking it on, man. 30, he's got nothing on you, I promise. For Matt Frankel, I'm Jason Moser. Thanks for listening, and we'll see you next week.